Hi, and welcome to the CFA Corner. I'm your host, Tim Fitzwilliams, principal of Fitzwilliams Financial and Fitzwilliams Wealth Management. And today we have our CFA, Mr. Ron Wright. How you doing, Ron?
I'm really good. How are you?
I'm doing great. Well, I think this is definitely something that we need to do today.
Yes.
For all our viewers out there, for all our clients, I know you're curious as to what's going on. So without further ado, let's ask the expert. Ron, what's going on? So much has happened, right?
Yes.
What is going on with the market and the economy?
Yeah, it's amazing. Last time we spoke, things looked very different. We thought we were starting off on the next leg of growth. We looked at GDP growth, we looked at inflation and interest rates, and it was a good picture that we were seeing. The Fed was getting ready to take the excess off the table because the economy was strong enough that would be able to handle it.
Right, they had printed some dollars and they were just going to take it off.
Right, so they were stopping all the stimulus, and it seemed like we were in a good spot. There was even references to a Goldilocks economy at that point. Then the war in the Ukraine broke out. And
that wasn't expected.
That was not expected. Nobody that I was in discussions with really anticipated this level of aggression. And especially not this level of sanctions. And that's really what is hitting the financial markets, is the sanctions, because that is really driving inflation, particularly in the energy area, in food. You know, that's the breadbasket for the world. Really, Russia and the Ukraine are the major exporters of wheat in the world.
Could you explain just a little bit for our clients and viewers what a sanction is? Because some of them may have questions about that. You hear it in the news, but is it really explained, you know?
Sure, it's think of it as a punishment, where we don't like what you're doing, so we're going to punish you by freezing your bank account. We don't like your spending money here, so think of your teenage child. You know, I don't like what you're doing, so we're going to freeze your bank account until you understand that what you're doing is wrong and stop with that behavior. So that's essentially that's what a sanction is.
But this also kind of hurts everyone else too.
Exactly, that's the problem, is when you stop one of the large economies in the world, you're effectively freezing them out of the global economy, and all of us are going to feel that.
And that's why, is that why we've seen like increases in gas?
No,
for example?
Yeah, absolutely, because of they're trying to carve out the energy sector from the sanctions, but they're having limited success with that. And so what's going on is it's driving up energy prices, and higher energy prices act like a tax on growth, so they slow growth, and all that is feeding together. So we've got inflation that's rising dramatically because of this, also slowing growth because of this, and that changed our perspective entirely. This was a real shift in where we thought we were to where we are. So we moved from what looked like a late stage 2 economy, which is that's early growth.
Following the economic cycle, the 6 stages.
Exactly. Now it looks like we're in late stage 4, which is late growth leading into early recession or contraction. So all these things together really moved us forward very rapidly, and that's why we've seen so much volatility in the markets, is because everybody's had to adjust and make these changes very quickly.
And inflation is now becoming an effect. When we talked before, we weren't so concerned about it because we thought they could kind of be spread out. But now we're seeing it more because of this event we didn't account for, which no one accounted for, was the Russian war situation.
Exactly, and that's one of the nice things about the models that we use. They allow us to be nimble and to make changes quickly when the circumstances change. So we can make those moves and make the adjustments.
And one of the results we mentioned briefly was inflation.
Yes.
Because we thought it was going to be under control, but now because of the war that it's not under control.
Right.
So what type of inflation are we looking at, right? People hear that word. Do we have a percentage that we can kind of give the viewers and our clients of what we're expecting inflation to be and what it is now?
Well, right now, the last CPI, Consumer Price Index report came out, and inflation was running at 7.9% annualized, which is the highest in 40 years plus.
And how many?
I believe 40 years.
Wow,
So,
that's crazy. So if you have money in the bank, just sitting in cash right now, you're really kind of burning
Yeah, it's
at about 7-8%, depending on what you're getting.
exactly.
We used to worry about, oh, I'm not getting a good rate in the bank. Now we're talking about actually
Losing
losing money.
money just to have it in the bank.
Absolutely, wow.
So the forecast, we'll get another print or report of CPI next week on the 12th, on April 12th, and we'll see where that goes. But all indications are that it is going higher from there, and I don't think it is outside the realm of possibility that we hit as high as 10% before it peaks, and then hopefully we'll see
10%,
a
okay.
move down.
So that's on the realm. That's actually something that you
I
could see
think that's
happen.
a realistic possibility. Yeah,
So obviously the Fed wants to do something. That's the whole
Exactly.
conversation, right?
exactly.
And the Fed, that's all we hear about here. Well, they're going to hike interest rates. Where's this coming from?
Right.
So it's coming from the need to have to counteract this inflation. So what do we think interest rates are going to look like?
Exactly. You know, it's just to kind of set the stage. When we spoke last time, the market was anticipating 2 to 3 Fed rate hikes this year.
Sure.
Now the market is anticipating, we've had one, and the market's anticipating an additional 8 quarter-point hikes this year.
That's a good bit.
2 of them grouped together as 0.5% hikes at each of those 2 meetings. So,
Wow.
and then
They're taking it serious. They're
They are
really
taking
trying to reel this in. So they're concerned about this inflation going possibly
Yes.
into hyperinflation if not controlled.
Exactly. So they're doing
That's very serious.
everything they can. They're also taking money. So the Fed has built up a balance sheet, a huge balance sheet, and now they're going to start letting that go. They're called rolling it off. So they're going to let those bonds mature and not reinvest the money. So they're going to start reducing the size of their balance sheet by about 95 billion a month. So a little over 1.1 trillion a year at this point, and could go faster. There's been some talk from Fed officials of actually, instead of things just maturing and rolling off, actually selling bonds from the balance sheet in order to reduce the size even more quickly.
Okay.
And that's a process called quantitative tightening.
The opposite of quantitative easing.
Exactly.
So instead of printing the money, we're tightening it now.
Exactly.
And we're also, so you're saying we're not only raising interest rates, we're also using other tactics.
Yes.
So they are aggressively trying to control the inflation.
Very aggressively. Very aggressively. We haven't seen this from the Fed since prior to the financial crisis.
Wow.
I would say too that as we're looking at interest rates, where are we maybe going to land? So
Yeah, what is the expectation there?
right now the terminal rate for the Fed funds is about 3.3%. That's where I think it's going to peak right now. So if we roll that out a little bit, the 2-year Treasury bond is usually about 0.5% higher than that on average. So that would be a 3.8% 2-year. And then the 10-year note, which is what mortgages are based off of,
Right.
usually
Everybody
a
wants
half
to
to
do
1% higher
that. Okay.
than that. So we could realistically have a 5% 10-year Treasury.
So we're talking maybe 5 to 7% is what you'll see in mortgages.
Yes.
Okay. Well, that's really important, ladies and gentlemen. If you have a mortgage, or if you're thinking about a mortgage, you need to understand what the net effect here is that's occurring. We're going to see this interest rate go up, and we're talking about it might shake out to be about 5 to 7% as a consumer that you would be paying on your 30-year fixed mortgage.
Right.
Wow, that's a lot different than 2%, isn't it?
Yeah, things have changed dramatically.
So the results of that, when interest rates go up, that lending is going to be harder and harder to achieve as well for the homeowner.
Yes.
And so we'll probably see rents start to increase.
Yes. Which is a problem because rents have been increasing. Down to Miami was the highest in the United States last year. Rents rose by more than 30%.
Wow.
So they don't really have a lot of room to go. Yet, if there's no housing available, if people can't buy a house, they have to rent. So that compounds the problem there,
Now the other thing,
which is inflationary.
absolutely, and the other thing that has to do with interest rates, and you mentioned briefly, is how bonds are looked at. Help us understand a little bit about that relationship, and what should people do? Because everybody hears, oh, I should be in a 60-40 portfolio, or 50-50, or whatever your risk tolerance is, but a portion of that is the bond. That's the hedge.
Right.
That's what people are relying on as their safety net a lot of times.
Yes.
So help us understand how this rise in interest rates will affect bond portfolios, and what should we be looking at in our bonds to determine whether or not we're in the right spot?
Right, so it's important to understand, most people when they hear bonds, they think immediately of treasury bonds. That's the market they're thinking of, but there are a lot of different sectors in the bond market that you can take advantage of. And so that's one of the things that we do within our portfolio, is to invest in bonds that are less inflation sensitive. And that way they aren't as impacted as greatly when these rates go up.
Okay.
We're in a tightening cycle, you want to be less inflation sensitive. Absolutely. So we use a lot of tools to do that, and some hedging techniques that we use. And as an example, you know, just this last week, I was looking at the numbers for this week. In the bond market, of course, with all this that's going on with the Fed, has greatly impacted bonds. Long bonds dropped by about 3.7% so far this week in just 3.5 days.
Wow.
The aggregate bond index dropped by 1.2%, but because of what we're doing in our bond portfolio, it was flat, so I didn't lose anything.
That's awesome, and that's a testament to you being on top of it and staying on that weekly rebalance that you do and looking at those things. Because as a whole, we would say most people that feel they're doing themselves and they got a 60-40 or 50-50, that bond section probably isn't going to be flat.
Right, and not for a long time.
And that means then that they don't really have a hedge.
Right.
So if you're out there and you're doing it yourself type person, that's fantastic, but please make sure that you're doing the research and the analysis of your bond portfolio to understand what you have, because now what you thought might have been your safety net, your safety hedge, it's probably not going to be like that for a long time, as Ron just said. So that's really important. A lot of people have always thought, oh, well, I'll just have some bonds and it will balance things out. It's not that simple anymore.
It used to be a set it and forget it kind of portfolio.
Right.
I just buy some bonds, let it go. It'll earn some interest and also some capital gain, and it'll all be good. And that worked for a very long time, but we're in a completely different environment now. We've not seen, again, inflation like this in 4 or 5 Fed chairmen.
Right, and at the firm here, we talk a lot about the idea of convex asymmetric risk. In other words, bond alternatives, because if you want to hedge, there's not just bonds, there's other solutions out there as well.
Absolutely.
And that's something that at Fitzwilliams Financial, we pride ourselves on being able to help you as the consumer and the viewer understand what are the alternatives outside of the bonds. So it gives you options, and that's what it's all about, being a fiduciary-based firm. We want to make sure you have as many options as possible, and Ron is one of those options, but we also have other alternatives to allow us to hedge your portfolio, whereas, can't say it enough, in this time, it's really difficult to do that on your own. So that means growth is going to be affected.
Absolutely. So yeah, you have inflation coming up, and energy inflation in particular, which act as a tax on growth. So that's going to restrain growth. Higher interest rates. The intention of higher interest rate policy is to slow the growth down.
That's the whole point, right?
That's
to
the whole
slow
point.
down the
in order
train.
in order to slow the inflation. So the whole thing is pointed at reducing the growth in the economy. Right now, first quarter GDP is leaning towards about a 0.7%, which is.
Could you explain just real quick to those that might not know GDP, GNP? They hear there's different things.
Oh, sure.
Would you mind just giving a quick little definition, if you will,
Sure,
of
yeah.
GDP?
GDP is gross domestic product. So it looks at several sectors of the economy and weights them in different ways. Government and employment and imports and exports, and then puts a number on that for the growth of the economy as a whole. And so that's what we look at. That's the broadest measure generally of economic growth in any economy. So we look at our GDP in the United States, we look at China's GDP, we look at European GDP to tell, are those economies growing or contracting?
And it's helping us understand how these companies are doing, right? How they're faring.
Right, how all the countries are relating. And then the typical definition of a recession is 2 consecutive quarters of negative GDP growth. So contraction of 2 quarters.
And you're saying Q1's 0.7, so we're getting mighty close.
It's kind of like slamming on the brakes from where we were,
right?
Almost 7% in the fourth quarter to 0.7% in the first quarter. So that's I'm already seeing forecasts of that first negative quarter in 2023 to start 2023.
Wow, so that's exactly what you were just saying about how we just kind of slammed through the market cycle of 3.
Yeah, absolutely.
We're moving right along. We're definitely into some 4, and we might pass through 4 rather quickly
We could.
because we can see a recession type trend on the horizon. As you said,
Right.
you just saw some forecasters. Now, ladies and gentlemen, that doesn't mean everyone. There's all types of folks out there that have things to say. But we take all that into consideration, and we want to be understanding of what these forecasts are. We don't want to be in the dark. And so Ron constantly looking at stuff every week. He's looking at these things, and you're in agreement that there's definitely a type of recession environment that's out there on the near horizon.
Right. I think
Wow.
at the best case scenario, we have what we would call a growth recession,
Okay?
which is just a contraction down to almost no growth.
Mhm.
And then, of course, worst case scenario is that the Fed really oversteps, makes a big policy error by tightening for too
Even
long.
more or longer. Okay.
And then that would lead us into a more serious recessionary environment.
Right. Wow. So the clients that we have together, they sign a limited power of attorney. You have discretion over their accounts, and the reason, ladies and gentlemen, that we do this is because he's looking at things on a consistent basis, weekly, looking at how he needs to change things. So let's understand a little bit, for those of you out there, what the current positions are and how active he's on this portfolio to kind of manage the overall Fitzwilliams wealth model.
Yeah. So it's just to give you an idea of how quickly we can move on things. The day after Russia invaded the Ukraine, we started making adjustments. And the very next day after the invasion, we did more than 1,400 trades that day to reposition our clients and begin that transition towards what looks like late stage 4, early stage 5 environment.
And this is scientifically analyzed. You're looking at this with science and your history and your expertise. You're not day trading based on a forecast that you just are looking at trends. You're really doing the math and the analytics to figure out to trade. People hear you trade, in a day. We're not day traders. We're not stockbrokers.
Right.
This is a portfolio manager. When he's saying he's doing that, what you need to understand from that, ladies and gentlemen, is that if you're not doing that, it's going to be really hard to keep up.
Right.
And if you're just doing it because you're reading a headline, that's not good enough anymore.
Yeah, generally the headlines hit 2 or 3 days after.
A little later, right?
We get the real story.
Absolutely. So some of your current positions that you have that you want to kind of share with
Sure,
our
so-
clients here?
Yeah,
What you got
just
going
as
on?
an overall.
Okay.
So we've reallocated pretty dramatically. From being fully invested, now we have about a 30% position in cash.
Okay,
for-
30%.
For both of our stock-based strategies. And our bond strategy is about 45% in cash, and that's because of the hedge that we have in there.
Well, Ron, thanks for all that wonderful information. You gave our viewers and our clients a lot of insight as to what's going on, inflation, interest rates, and growth. Well, let's talk a little bit about where we are today with the Fitzwilliams Wealth Management portfolio.
Yeah, absolutely. So overall, we've shifted to a much more defensive stance, so that within both of our stock-based portfolios, we're about 30% in cash. And within the bond portfolio, we're in a hedged position that gives us about 45% in cash position. So very, very conservative, especially considering just a few months ago, we were 100% invested in all of those portfolios.
Now, I know a lot of folks out there, clients, especially viewers, if you're not clients, might be like, well, why would this firm be any good? I'm paying you to invest my money and you're in cash. Could you give some insight as to why you're in cash?
Right, exactly. Well, that's a defensive position because in cash, we're hedging the risk of the portfolio. So we're bringing the risk level of the portfolio down dramatically and holding cash rather than holding a stock that's going to be declining. And bearing in mind with all this that the natural tendency of the stock market is to always go higher historically. But that doesn't mean it's going to be going higher during a recession.
Right.
And we also don't know exactly when that's going to end. So we don't try and time the market, which is relatively impossible.
So if they're listening and they hear, oh, we were doing inverse bonds or we're doing these things or I'm going into cash, do you recommend any of those theories or strategies for the non-professional advisor that's doing it themselves, if you will?
Yeah, it's an incredibly difficult thing to do, and to do well consistently.
You say it's difficult.
Yes.
I'm just going to go ahead and say that, ladies and gentlemen. You know, you guys can Google CFA. It's one of the hardest things in the world to get. My opinion and many other opinions behind that. He's saying it's difficult. Oh, look, save yourself the headache. Don't continue trying to do it yourself, and don't think that you can just Google this and figure it out. When someone like him is saying it's difficult, best believe, ladies and gentlemen, we're in for a rough road, and we want the best pilot of the ship we can get. So it's nice to hear that you're our pilot, but even that you are admitting that this isn't easy. You have to navigate things.
Yeah, absolutely, absolutely. So we don't try and time the market. Our investment horizon is not today, tomorrow, next week, or even over the next month. It's longer term than that. And so we take these defensive positions because we want to conserve our clients' capital through the decline. And then once we see that there's been a shift to the next economic stage where we're going to see some growth coming back, then we can start redeploying that cash and put them into the places where they need to be. So it's always making sure we're in the optimal allocation for where we're going.
Excellent. Speaking of horizons, what do you think the future, and I'm not saying crystal ball, the next 5 years, I'm just trying to get an idea. Do you feel like we're talking about recessionary activity on the horizon? We're talking about zooming past the third cycle of the economic cycle. We're talking about inflation, interest rates, combating it. We're talking about all these things. How do you feel the market's going to be over the next year? Is it going to be a pretty smooth ride? Is it going to be pretty volatile? Do you feel like it's going to balance itself out? What do you see in the near future? Let's say 6 months to a year from now.
Well, I think that there's no question that this volatility is going to continue. I think that the risks continue that are much higher towards the downside, meaning that it's more likely that we're going to see markets going lower from here for the short to medium term. There's just so many things that are stacked against it. And one of the things you always have to keep in mind is you don't fight the Fed. And right now the Fed wants to slow growth to rein in inflation, and they're going to do everything they can to do it. And when you slow growth, that slows earnings. Inflation compresses those profit margins, so earnings decline, and earnings are what drive stock prices. So if we have earnings coming back and declining, then naturally stock prices are going to do the same. So it's going to be very volatile. There's going to be a lot of ups and downs, and that's one of the reasons we take those larger positions in cash to buffer the portfolios against that.
Which you've done in the past.
Yeah. Yes.
That's one of the great things about you. Just as a reminder, ladies and gentlemen, in 2008, when the market lost 50%, this guy, he lost about 25%, where it took everyone else about 4 years to get back from the bottom. He brought his clients back in 8.3 months. Not saying that's what it's going to be. We're not saying it's going to be a perfect ride, but again, having the best pilot of the vehicle, driving and piloting that ship is what we're looking for. And we feel we have that with you.
Thank you, Tim.
And utilizing those tactics that you've discussed today, like the inverse, like holding in cash as a defensive position, recognizing that economics is a part of investments. I had lunch, ladies and gentlemen, with another CFA not too long ago who didn't believe economics had any place inside of investing. So there's a lot of different viewpoints out there. And Ron does believe that economics matters. And it's relative, as you can see in his history of his performance. So we are prepared for that volatility, and we are prepared to walk through that. It won't be the end of the world, right? But it does mean it might be the end of the do-it-yourselfer.
Yeah, we've been through a period of extremely low volatility for so long. And last year's going to go down as the year of the social investor. Mm-hmm. All the meme stocks that we remember, GameStop.
Yeah, just buy whatever you see on Reddit, right?
Exactly. And
no research needed.
No research needed, and it seemed to work. I think that era is gone for now. Now we're moving into a new stage, and as we roll in the economic cycle over to stage 5 and into stage 6, it's going to be critical that you're in the right positions ahead of time to hedge against that downside and be ready for when things do bottom out to take advantage of moving back to the upside.
No more autopilot.
No.
A lot of people have been putting into their 401ks, not thinking about it. We hear sometimes, oh, I just don't look at it, right?
Yes.
And if you got 30 years, maybe that'll work, right? But if you're a retiree or you're a pre-retiree and you're focused on retiring here soon, I urge you, ladies and gentlemen, give us a call at 757-961-0700. Let's get your quarterly review done a little early this year. Let's get you in here and let's look at your cash positions. Let's look at your bond holdings. Let's look at what you have going on so we can get you in the right harness to weather this volatility. I don't want to see you guys lose money when you don't have to because you think that you can weather the storm. This is not the normal market that a lot of us have been exposed to since '08. It's been easy. It's been autopilot. Now is when we need the professionals and the best of the best, like Ron, to be able to navigate us through this turbulent time. And I have 100% faith in you. I know our clients have faith in you. Again, I urge you, come on in. Let's sit down. Let's go over your current scenario. Let's go over your portfolio. Let's see what Ron has to say. Let's see if we can put you in a better position. If you're not a current client, then give us a call. We'll do an interview with you. We can do it over the phone. We'll identify what you want to accomplish, and then we'll look at your portfolio and we will give you a Morningstar report to talk about where your portfolio has shortfalls. And I think you're going to find that there might be more shortfalls than you may think. So I urge you to at least get a second opinion. Give us a call, 757-961-0700. As always, Ron, I greatly appreciate you coming in. I love doing this with you. I think it's important for our viewers and for our clients to know where we are because this isn't normal. This relationship here is not normal. We're blessed and honored to be able to have you as a part of the firm and helping us manage the portfolio. Until next time, I'm looking forward to seeing you again. Thanks a lot. You guys have a great rest of your day. God bless, and we'll talk to you soon. Bye-bye.